please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
All right, then let's take a quick check on the Asian markets. Remember, they've opened up on the back foot. This after Fed Chair Jerome Powell indicated gradual rate hikes. The Nikkei is down close to around 0.5% as we speak after the industrial output fell at a faster pace than in fact expected. In fact, it fell at the fastest pace we have seen since March 2011's earthquake. The Kospi as well is down close to around 0.3%. In data coming out of China, then we had the growth in Chinese services as well as manufacturing industry. Both of them slowed in the month of February. An official survey showed on Wednesday. That's suggesting key sector is starting to display signs of fatigue. Well, we have the other couple of markets as well that have opened up. The Taiwanese index, though, that one is shut in today's trading session. The Straits as flat as can be. The SGX Nifty as well should come up for you. Well, it's indicating a bit of a negative start. Maybe, in fact, we'll see even a 70-point downtick just to kickstart trade.
All right, well, let's tell you about the U.S. markets. The U.S. markets fell for the first time in 4 days, with the Dow shedding 299 points after the new Fed Reserve Chair Jerome Powell signaled that the Fed will, in fact, keep raising rates to contain inflation. U.S. Treasury yields have risen sharply during the testimony, with the benchmark 10-year yield adding 5 basis points to hit 2.91%. CNBC's Aditi Roy gets us a wrap of all what took place.
Starting with the Dow, it fell 299 points after Powell's comments signaled the central bank could hike rates more than 3 times this year to keep the economy from overheating. Disney and Home Depot weighed down the 30-stock index. The S&P also falling 35 points or 1.27% as real estate, consumer discretionaries and telecom pulled the broader market lower. The Nasdaq fell 91 points or 1.23% amid declines in Facebook, Amazon, Apple, Netflix and Alphabet. U.S. Treasury yields, as you mentioned, rose sharply following Powell's optimistic comments, with the benchmark 10-year Treasury note adding 5 basis points to hit 2.915%. And the U.S. dollar popped too, the index nearly reaching 90.5 points.
Well, and Federal Reserve Chairman Jerome Powell has downplayed the concerns over the recent market volatility. Now, in his first appearance before the U.S. Congress, Powell indicated that the Fed plans to hike rates 3 times this year and may be inclined to even a 4th. Let's listen in.
These interest rate and balance sheet actions reflect the committee's view that gradually reducing monetary policy accommodation will sustain a strong labor market while fostering a return of inflation to 2%. Engaging the appropriate path for monetary policy over the next few years, the FOMC will continue to strike a balance between avoiding an overheated economy and bringing PCE price inflation to 2% on a sustained basis. What we've seen is incoming data that suggests a strengthening in the economy. We've seen continuing strength in the labor market. We've seen some data that will, in my case, add some confidence to my view that inflation is moving up to target. We've also seen continued strength around the globe, and we've seen fiscal policy become more stimulative. So I think each of us is going to be taking the developments since the December meeting into account and writing down our new rate paths as we go into the March meeting, and I wouldn't want to prejudge that. It's very typical for the yield curve to flatten as short-term rates come up as the economy strengthens, and I don't see a particularly large. There's always a risk of a recession at any given point in time. I don't see it as at all high at the moment.
Okay, and CNBC's Sri Jagaraja analyzes the impact of Powell's testimony on the U.S. market going forward. Let's listen in.
A somewhat hawkish view on inflation. That rankled the market, and it also had an impact on the rates market as well. We saw the 10-year yield move up to above 2.9%, 2.92 in that region is what we saw. Not quite 4-year highs, but moving in that direction once again. So let me just stress for you, if I haven't done so enough, that this bond equity correlation quite strong right now, and any move higher in the 10-year yield is going to upset the stock market. So this is going to be an evolving process. And the other factor here, going back to the point that we raised earlier, is that the market seems to be trying to adjust to the perception that everything that Mr. Powell said in balance may be consistent with 4 hikes as opposed to 3. And that's certainly a view that was echoed by Robert Heller, a former Fed governor who we spoke to earlier on this morning. This is what he had to say about the pace of rate hikes in 2018.
Well, if I were going to vote, I would vote for 4 increases, you know, to get back to a normal rate structure is very important at this juncture in the economic cycle, because the economy really is booming. We have low unemployment, we have good growth, over 3% at the present time, and so, you know, to continue to have very low rates is not appropriate. Let's go for 4, I hope.
So I think Mr. Heller there also making a nod to the risk of leaving rates too low for too long and not carrying on, not cracking on with the process of tightening. And the longer that the Fed leaves it, then the higher the risk of asset price bubbles and financial stability risks arising. And that, of course, was a view that was echoed by Yellen before Jerome Powell. So that is really one of the central arguments in favor of the tightening process.
Okay, all right. So turning attention to the European markets, well, they ended yesterday's trading session in the red. Investors waded through the latest corporate news as well on the bourses. Now, in fact, if you look at all the 3 frontliners, they ended in the red, so it wasn't good going. But even if you look at some of those emerging markets yesterday, the Brazilian and the Russian index, both of them came in for selling. Both of them were down roughly around 1% in trade. But if you're looking for green in overnight trading session, well, the Ukraine index, we don't normally track that one. But in yesterday's trading session, it was up more than 2%.
All right, let's tell you about the currency space. The dollar stood near 3-week highs against a basket of currencies on Wednesday. This is after the Fed Reserve Chairman, his upbeat views on the economy really bolstered bets on whether the Fed would hike interest rates further this year. The dollar index, which measures the greenback against a basket of 6 currencies, last stood at 90.414 after hitting a high of nearly 90.5 on Thursday, strongest levels that we've seen in almost 3 weeks. Well, back home on the Lal Street, the markets took a breather after 2 days of consecutive rallies. So the financials dragged the Nifty lower, where PNB posted its biggest one-day fall that we've seen in the past 4 years. However, Nifty managed to hold fort at levels of around 10,500. The mid-caps too took a beating in trade yesterday. But how are we poised for trade today? Naveen joins in to tell us more. Naveen, morning.
Good morning, Ekta. As you clearly pointed out, consolidation was the name of the game yesterday after a run in the last 2 days post the new series in March. We saw some bit of a consolidation, majorly led by the bank index. If you see month to date from February 1st till date, Nifty is down close to 4.3%. On the other hand, in terms of the institutional activity yesterday, FIIs, they have sold close to 9,000 rupees. Meanwhile, DIIs, they have bought in close to 1,100 crore. Remember, this is a clear pattern that has been going on for the whole of the month. So if you pull up the whole month chart for the month of February, FIIs have sold close to 16,860 crores in the cash market. Meanwhile, DIIs, they pumped in close to 16,200 crore. So more or less balanced in that way. On the other hand, some bit of a niggling worry would be that the Nifty premium, that has come down from 18 rupees to close to 9.75. So that has narrowed down by almost 8 to 9 points. So that is a bit of a niggling worry. On the other hand, if you look at the levels, on the upside, we would see a resistance at that 220-day moving average to that 50-day moving average, which is hovering around 10,617 in case the Nifty moves up. On the other hand, there will be clear support seen at around that 10,350 mark, around 10,340 to 10,350 mark. What are the global cues telling us today in the morning? Remember, the European indices, they have ended almost flattish, but Dow Jones, that hasn't been showing a pretty picture for the Indian markets. They have been down close to 1.2%. In fact, SGX Nifty is also indicating a cut and hovering around the 10,510 mark. So we'll have to keep an eye on the 10,500 levels in today's trade. Back to you.
Okay, all right. Naveen, so we'll be starting off closer towards the 10,500 odd mark as per what the SGX is indicating. But you'll be watching quite a few stocks today?
quite a few stocks, Nigel. So I'll begin with United Phosphorus. Remember, Motilal has initiated a coverage on the counter with an upside of close to 30% from the current levels. They believe that the overall spread in terms of the product mix that the company has, that will augur well for the company going ahead. On the other hand, DLF, that company emerges as the highest bidder for a land parcel in Gurgaon, which is around 12 acres. ABC India will also be in focus in today's trade, given the fact that the company has received an order worth 142 crores. A small order, but nevertheless significant given the overall order stream for the company. Fortis is also is one company which has been in focus for the last 1 to 2 months. But today, given the fact that the company has notified to the exchanges that there is no relation between the company and the ongoing proceedings against the Singh brothers in Delhi High Court. Cipla has partnered with Roche Pharma to create greater access to medicines. On the other hand, HDFC, the big boy, it has opened its QIP set at the price of around 1,824 rupees. Bharat Forge also has completed the divestment of its shareholding in Alstom Bharat Forge. Some bit of a completion of the deal. So not a big news, but still the stock will be in focus. On the other hand, Sadbhav Infra has been declared L1. And remember, in the last 2 weeks, I think this is the second time that the company has been declared L1 for an NHI order of around 1,000 crore rupees. L&T Infotech, the promoter has sold 2% stake in the company. But remember, nothing to worry given the fact that the company is just following the shareholding norms of SEBI. And that is one reason to bring it to 75%. And that is one reason why the promoters have sold 2% stake. These are the stocks and news from my side. Back to you.
Now, the big development in the PNB fraud case. Nirav Modi's flagship international jewelry firm, Firestar Diamond, has filed for bankruptcy in the United States. The company's diamond business is spread across the United States, Europe, the Middle East, as well as East Asia. Now, in its bankruptcy filing, the company has blamed liquidity and supply chain challenges for the crisis it is facing currently.
Okay, and in the wake of the PNB fraud, the government has sent a missive to public sector lenders. The North Block has instructed PSU banks to probe all NPA accounts over 50 crore rupees for possible fraud. The announcement was made by the Financial Services Secretary on Twitter. Sapna Das is here with the details. Sapna.
Well, as a fallout of the Nirav Modi scam, the government clearly is fixing the responsibility of the top brass of public sector banks. And basically on that account, two clear directions that have come out. One, of course, all public sector banks will have to look into all those NPA accounts of 50 crores and above and, kind of find out if any frauds have been committed within them. That's one. Second, if there is any evidence of fraud which surfaces within these accounts, and that is 50 crore and above NPA accounts, they're supposed to promptly file an FIR with the CBI or probably even the ED and DRI, whichever the concerned investigative agency is. So this is a very clear directive that has come in from the government. Apart from this, they have also gone ahead and set up a panel consisting of, or rather comprising of, the executive directors of all public sector banks as well as the chief technology officers to come together and give the recommendations in 15 days on how the IT platforms, or rather the technology platforms of all the banks should be tightened further. More important, how there should be a common operating procedure for all the banks on this front, so that scams like Nirav Modi are they don't actually go undetected, or rather there is no eventuality of their happening in the future. So on both accounts, of course, the strong advisory in terms of checking frauds within the 50 crore NPA account, that's a pretty stringent one, and also in terms of setting up the tech panel, that is also equally important. Apart from this, we also understand the buck doesn't stop here. A series of measures the government has been taking right since this scam has started or has come to light. The next one that we get to hear is that probably the auditing system in the public sector banks is bound to get tightened, and we should be hearing soon from the government quarters on this front as well.
Well, in fact, we spoke to D.K. Mittal, the former banking secretary, and V.G. Kannan, the chief executive of Indian Banks Association, on this particular issue. Let's hear out their views.
We have this reporting for last many years, and something for everybody, government, banks and RBI, is very important to look at what happened to these fraud cases. How much money we have been able to recover, what was the root cause analysis, what were the process failures, and have we corrected them out? Do we have a system that in future same fraud should not happen in any bank, particularly public sector bank I'm talking, in any public sector bank, because the learning from one bank should be translated into implementation in all banks. So I think that is a huge database we have, And I do not think we have recovered the money or we have taken lessons on board for the public sector banks in that respect.
This is more to reiterate saying that 50 crores and above is pretty large amount, and therefore we need to take extra care to say that account has become an NPA only because of business and not because of any fraud. So I think the government is trying to send a signal that the government is acting, especially after the huge fraud which has happened, and that is the signal which is being sent to the community at large, saying that we will not sit idle on these cases. And if there's 50 crores and above, you look into it, and if it's not a fraud, then there's no issue about it. And in case you have suspicion, please get it reported and let the action start. That's all.
Okay, and in a statement which was released by ICICI Bank, the bank informed that they have no exposure to the Nirav Modi group of companies. ICICI Bank informed that they have not issued any letter of undertaking, nor do they have any buyer's credit exposure against those LOUs with respect to the Nirav Modi group of companies as well as the Gitanjali group of companies. They also clarified the exposure to Gitanjali group of companies is not the largest amongst lenders in the consortium.